Hi, welcome to Numerix Video Blog. I'm your host, Jim Jockel. Joining me today is FX expert from Numerix, Udi Sella. Udi, how are you?
Thank you very much. Good to be here.
Udi, want to talk to you about a article that came out in Risk Magazine this past week. An article titled, Expert Warns of Corporate's Complacency Over FX Hedging Costs. And I guess basically due to lack of volatility in the FX derivative market, we've seen prices dramatically tighten over years. But what is interesting in this quote, the individual has not identified himself other than a senior treasury official at a global technology company. The quote is, what the corporate world sees now is absolutely fantastic. Hedging is cheap, transparent, and fast. What is worrying is that we see total complacency among companies, he says. Many treasuries are not ready for the possibility of price increase. In fact, they don't believe it ever will, and that's a dangerous belief. So, Udi, perhaps you can give us a little bit of guidance of what's going on in the market right now that is really kind of, according to this individual, is driven complacency, especially in regards to hedging being cheap, transparent, and fast.
Yes, of course. So if you may recall that a few months ago we had the webinar about the historically low levels of volatility across different markets, from the VIX, that was about the level of 10%, to foreign exchange volatilities were trading at 5-6 level. And I think basically the person, the senior, basically is inclined to the fact that corporates got used for very low volatility, and hence no need to hedge because I'm just wasting premiums or whatever I pay while the market is not moving. And guess what? Since the end of probably August or early September, the market started moving across all asset classes. So if we saw VIX at the level of 10%, last week we saw VIX almost at 30, so that's a huge jump. If we look at some emerging markets, typically Brazil, the Brazilian real went from something like 235, and we saw the short-term volatility there jumping into levels of like 26%. Having said that, in most markets, actually the implied volatilities are still pretty low. So we're looking at levels of 7.5 to 8, in the major currencies. So I think this is what this person implies. It's still relatively cheap to hedge, and given the Ebola disease, given the end of the QE easing in the quantitative easing in the U.S. and so forth, the crisis in Greece now, Germany going into depression, there are reasons to assume that there will be increased volatility in the markets.
And we've seen a lot of recent swing as it relates to dollar-yen, dollar-euro over the past couple of weeks, and that's probably going to continue to play out as well. I mean, especially as equities have been quite volatile given all of the negative news around the globe. In terms of this pickup in volatility, and yes, the VIX is blown out over the past 4 months at this point. Obviously this is probably good for sell-side market participants, but at what point or what should corporates start thinking about as the potential effects? I mean, obviously perhaps less efficient pricing and wider spreads.
Yeah, so I think you're actually implying to an interesting point, which is the impact of regulation on market volatility and gapping. So what we've seen actually during the last days or weeks is that very few banks now have appetite or mandate to maintain risk and to hold large positions. Therefore, when you need to, for instance, people trying to get away from holding Greek bonds, Greek government bonds, the yield jumped from 5.5 to about 7 because there were very, very few people that were willing to put bids, or in other words, to buy these bonds. And so since the risk, the appetite for risk has really declined, and given the cost of capital that this is required, this is one of the prices that we will have to pay for increased regulation. And indeed, this is what banks are now claiming, that they cannot, maintain positions anymore. It's just too expensive.
So what do
regulators have to take into account? Sorry.
So what are the indicators? What should people be looking for? Is it credit spreads? Looking at CDS spreads on governments? Where's the warning indicators that should be on the top of individuals' minds?
I personally the first thing I always look at is the 10-year bonds, the government bonds. So for instance, just an example, at the height of the crisis this week, we saw the 10-year Treasury, US Treasury, trade below 2% yield. So that was pretty remarkable. We saw the German 10-year bond bonds trading at the yield of 76 basis points, which is almost incredible. If you stick to these and follow them, you would see that eventually the equity markets and the foreign exchange markets actually follow up and catch up. And also interesting to say, you're mentioning volumes this week, we actually saw that the CME, ICE, CBOE all reported record volumes, records never seen. I think the CME, if I'm not mistaken, had a daily volume of over 36 million contracts traded, never seen before. Last year, the closes was maybe 10 million contracts less. So it was actually it was 39 million contracts, and the previous record was something like 26. So it's absolutely amazing. It's probably also an indicator that more volumes go to the exchanges.
Udi, I want to thank you so much for your insight on this. I mean, clearly, this is something that's going to be much more top of mind, especially as the markets continue this volatility trend that we're seeing now, and obviously people are going to have to start to rethink some of their strategies if this market continues the way it is. But so I'm definitely going to be tapping you for more insights as we see how the rest of the year plays out. So I want to thank you for joining the video blog.
Thank you for having me today.
And of course, we want to talk about the topics that you want to hear. Please feel free to follow us on Twitter at NX Analytics. And of course, we post all of our videos and company updates on our LinkedIn page, so you can follow us there as well as Numerix.com. Udi, we'll see you next time.
Indeed. Thank you very much.